Quarter. All right. Hey, everybody, and welcome back to our monthly commentary with Tim Holland. Tim, as always, thanks for being here with us and taking the time. We greatly appreciate it, man.
Sure. Happy to be here.
Awesome. Well, looking back in the month of July, it was a good month. The markets had major indices were up. S&P, Russell, 3% and 6% respectively. Looking at emerging markets, they did even better at about 6%. But that, normally we talk about the previous month, and there's a lot of positivity to talk about in the month of July and kind of what drove that. And we'll get to that.
Yeah.
But I don't want to bury the lead because as we record this, it's August, and we just got some interesting information today. And so, Tim, why don't you lead us off with the news that came out today in the markets?
Yeah, no, absolutely. And good to be with you, Brad. Hope everyone's doing well. So today we found out that Fitch, one of the big three credit rating agencies, downgraded the U.S. from AAA. So we have fallen a notch. This follows on almost 12 years to the day from when S&P did something similar. So we're long-term investors here, and we try not to get too caught up in day-to-day moves. But it's a big headline. Markets are off a little bit today. We don't think it's going to prove consequential to the economy. The issues that Fitch has pointed out, there's some governance dysfunction. We've seen that in DC for a long time now. We've got a lot of debt. We know that. The U.S. remains the world's largest economy, the most important economy. We print the world's reserve currency. So even as someone in this profession once told me, the markets, the world is sort of a laundry basket full of dirty shirts. We're still the cleanest shirt among those dirty shirts. So it's not good to see. We don't think it'll have a lasting impact, but it's certainly driving markets today.
Yeah, and it is interesting to note because, to your point, I remember when the S&P downgraded U.S. debt. For those people that don't quite understand what that is or what that means, can you just give us a little context of what it means to quote unquote downgrade debt and what we're talking about there?
Yeah, no, that's a great point to make. So think of the U.S. government, which is going to issue bills and notes and bonds to fund its day-to-day operations, right? We spend more than we take in.
Yeah.
So we have to raise funds.
Good point. To pause there. We spend more than we take in. So if the United States were a person, they make $100,000 a year and they spend about $140,000 a year.
Yeah, it's good to be the world's most important country because you can do that. Tim Holland, not so much. I've tried. I'm just kidding. So think of the U.S. then as sort of a company, and these agencies like Moody's and Fitch decide how creditworthy the U.S. is and how likely the U.S. is to pay back the money it's borrowed from individuals and institutions and even other sovereign entities around the world. So we're still just about as highly rated as you can get, but we slipped one notch. We're still in rarefied air, but what they're essentially saying is the U.S. has some problems. We're not necessarily addressing them. We're not going away anytime soon. You can still lend money to these folks. But if we were the absolute gold standard a day ago, we've got a little mud on that gold plating, if that makes sense.
Yeah, I think a good analogy to use, again, going back to kind of more personal finance that people probably understand because it's their day today, is the United States has a credit score just like you and I do, right? And it can be a 580, right? When you're the person that's a high risk, which means you're going to pay higher rates, that kind of stuff. Or it could be an 850, which means you're going to kind of get best in class, that kind of deal. And so the United States essentially went from an 850 perfect credit score down to like an 840 or an 830. It's not like we walked it and we're a junk lender or anything like that anymore. It's just that we're not that AAA rating anymore.
Yeah, no, and that's a great point. And if you were to draw a line from sort of the rating agencies' decisions to the U.S. and its impact, you just hit the nail on the head, Brad. It's that in theory, it should cost us a little bit more to borrow, right?
Yeah.
We're a little riskier today than we were yesterday. We'll see about that. Again, we have the world's most powerful central bank. We print the world's reserve currency. Whether or not there will be any impact to our ability to borrow and the cost, time will tell. Bond yields have moved up a little bit here for sure. I think that's more around the idea that the economy's done a bit better than people thought. And maybe some inflationary forces are starting to perk up a little bit, and that hasn't had really anything to do with the Fitch news.
Well, Obviously, we're starting off with news that doesn't necessarily equate to July because we're now a couple of days into
Yeah,
August as we record this. But going back to July, the good news is, although the market's off today, we did have a good month overall.
yeah.
Most major indices had a really, really good month. And so, what drove July? Why did we see an uptick in most major indices in July?
Yeah, I think at least for the U.S. and the returns we've seen both in the month of July and we saw in the month of July and year to date, it's this combination of falling inflation, maybe not as fast and as far as we would like, but falling inflation, corporate profits coming in a bit better than expected. Right, we're all
Yep.
paying attention to the quarterly earnings reports that companies announce, and right now we're right in the thick of the second quarter. And I think you put those two things together, along with the fact that even coming into July, a lot of people were pretty pessimistic about the stock market. I think
Yep.
a lot of money, as they say in our business, Brad, right, has kind of been on the sidelines and
Yep.
maybe been in cash even since the end of last year because last year was so unpleasant. So I think those three factors really kind of helped things go in the right direction in July. And I think those are the three factors that have really helped the entire stretch of 2023 so far.
Yeah, of all that data that I guess stuck out to me, right, wrong, or indifferent, is that by I think it was yesterday, about half of the S&P had reported on Q2, like
Yep.
financially what happened for them in Q2, and based on expectations. Because if you're unfamiliar, the prognosticators are always out there building expectations of what should be happening in these for these estimates and how they think these companies are going to perform. 79%, almost 80% of these companies that have reported their earnings are coming back and beating expectations. So
Yeah,
I
it's a
think
big
that has a
deal.
lot. I don't know. That's the one that stood out to me.
No, I think you're right. It's funny. It's not really when it comes to earnings and corporate profits, to your point,
Yeah.
the level of earnings. It's the level of earnings relative to where the world thought that number would hit. So in life, managing expectations is a big
Yeah.
part of it. And to your point, companies are real good at sort of setting those expectations a little bit low and then
Sure.
hopping over that bar. And if people are pessimistic going into that kind of dynamic, that can certainly lift sentiment towards a particular stock or the market overall.
Yeah. To make an extreme example, to make a point there, Tim, sometimes the
Yeah.
expectation is they lose money. And
Yeah.
to beat it just means you lose less than they thought you were going to
Yeah.
lose. And that actually raises stocks prices sometimes. It's because you lost less than
For
they
sure.
anticipated, not because you actually made money.
Yep.
Another
Absolutely.
interesting note of being publicly traded in the lesser to a lesser degree than the United States as a whole, but some of these publicly traded companies aren't actually expected to be profitable at certain phases of their life cycle. So, real quick thing I wanted to touch on before we end today and kind of
Yeah.
July, which was a good month overall, like we talked about, is Europe. In the
Yeah.
market commentary, which we will attach to this as we always do, you just kind of made the comment that it should remain a point of interest, and there are a lot of headlines about Europe right now. So, can you give me a little bit of flavor of what's going on over there and what to watch for?
Yeah. So Europe and the European Central Bank, their version of our Federal Reserve, right? They set interest rates across the European Union. The Federal Reserve does it for us here at home. The Bank of
Yeah.
Japan is a big central bank as well. So the ECB, as it's known, the European Central Bank, the ECB for shorthand, raised rates just like the Fed did
Yeah.
last month. But what's interesting is we've seen, I know prices are still high and price levels are still high, and people are still struggling with higher prices at the pump and at the grocery store. We've seen a lot more progress on the inflation front than Europe. And where we've gotten a bit more better than expected economic data, they're starting to see, on balance, weaker than expected economic data. So if you're a central bank and you want to bring down inflation, because that's one of your big responsibilities,
Yeah.
but you're seeing weaker economic data at the same time, you start to get a little worried that if you keep going, you're going to put the economy into a recession. Here at home, that fear is really dissipated because the consumers hung in there and jobs have hung
Yeah.
in there. They don't have the same support in Europe. And so people are a little worried that the ECB is going to have to stop raising rates with inflation as high as it is and the economy weakening. And that could lead to a euro, their dollar being worth a little bit less. And it's more likely than not that they're closer to a recession, whereas we seem to be going the other way. So I think people, justifiably so, are a little bit nervous about Western Europe right now.
Yeah. That's a really good point. Thanks for sharing that. I just want to close by saying this, as a long-term investor, you made that point, and this is always going to be the disclaimer in these monthly catch-ups. As a long-term investor, right, you shouldn't be making micro movements or macro movements based on micro decisions on a month-by-month and data that's coming out. But just generally speaking, any sort of opportunities out there or shifts that you're seeing in the industry as a whole for long-term investors?
I think the point I would make, and right, my crystal ball remains as fuzzy as it's ever as it's ever been. And we've talked about markets a lot, Brad, the last couple of months. We're in a new bull market, right? The S&P 500 is up 25% or so off that 2022 low, and I think it's a new bull market that caught a lot of people off sides. If history is any guide, and past isn't always prologue, but if history is any guide, bull markets, tend to run for 4 years, give or take.
Yeah.
And we're early in this bull market, if history is any guide. So to your point, you don't want to get too caught up in the short-term data. There's going to be bad news. Nothing goes up and to the right every day, for sure. Yeah. But we've been through a lot as an economy. The stock market's been through a lot. And again, knock on wood, if past is prologue, this bull market should have meaningful legs to it. And I think that's a point worth keeping in mind, especially with some of the scarier macro headlines of the day.
Yeah. Tim, as always, much appreciated you joining us for our monthly update here. Look forward to seeing you for our August update. And yeah, thanks again. Always appreciate having you on. Everybody, if you've got questions, concerns, or anything else, feel free to reach out to us here at Fiat or contact your advisor directly. You can get a hold of us at fiatwm.com. All of the information is there. Hopefully if you're a client of Fiat or family that we work with, you know how to get a hold of your advisor. But as always, thanks for listening. Tim, thanks for joining us, and we'll see you all next month.